Hello and welcome to Bangalore International Centre's very own podcast, BIC Talks. Bangalore International Centre is a platform for informed conversations, exchange of ideas, and a space for arts and culture. BIC Talks brings the essence of all that the physical space stands for and more to your doorstep.
Hi Narayan and welcome back to BIC Talks.
Hi Pavan, nice to be here again.
My pleasure entirely, and you were here in our previous episode, number 46, to talk about the recent announcement from the US Fed, right? That it will be prioritizing employment over inflation for the first time in decades. So last episode, Narayan, you shared a history of the Fed and its mandate, and you also indicated that the US economy might show cyclical recovery in 2021. You're quite optimistic on that count. So thank you for joining us again on episode 47. And here we want to take off from what we discussed in the last episode. And we want to discuss the other priorities of central banks, be it in India or in other emerging markets, as well as what the US Fed's actions might mean for our economic recovery here in India as well as across the world. So first off, last episode you mentioned how the seeds of the US Fed came from the likes of Alexander Hamilton in the late 1700s, right? And though it started there, the institution really took shape in the early 1900s and had an initial mandate of banking sector stability. So could you walk us through when and how institutions like the RBI and others were set up and what their mandates have been?
Terrific, Pavan, and thanks again for having me on the show, and delighted to speak about both emerging markets, central banks in general, but also the implication of the Fed's somewhat significant decision from late August. So let me begin by saying, and maybe we didn't even say this last time, that we didn't talk about the history of all central banks. We spoke about the history of the Fed. But if you were to wiki it, I think you will see, for instance, that the history of central banks, like many other things, actually goes back to the UK and sort of winds its way through Europe, actually Sweden and Amsterdam, and then eventually ends up as an idea that, among other people, sparked Alexander Hamilton's interest for what happened eventually in the United States. So there was this sort of federal banking regulation idea that began in the Age of Enlightenment in Europe and then spread eventually to the United States. For emerging markets, there are basically two types of central bank history, broadly. One type of central bank history is an evolving sort of institution that took place from a predecessor nation state, and even though the nation state changed its form, ended up in the new nation state in its new form. So the RBI is actually the simplest example of that. The RBI started in 1934. The early stages of the RBI actually were in British India in 1925, officially got incorporated first as a private company and then as a government company in 1934, and then became the Reserve Bank of India just after independence. So that's sort of the quick sort of genesis or birth of the RBI itself.
So Narayan, would this mean that the RBI was sort of affiliated to the Bank of England in some manner till independence, or did it still act reasonably independently?
It was actually quite independent. If I'm not wrong, the Imperial Bank of India, many years before its official reincarnation as the RBI in 1934. So effectively, the history of central banking in Asia in particular, in some other markets as well, was the colonial powers had granted the power of currency to the largest private bank, so to speak. And so this happened in Indonesia under the Dutch and a few other banks around Asia in particular, where these entities were then allowed the power of currency and de facto became the central bank that reported for just the central bank function of it to the government, but for all other practical purposes also functioned as a private sector bank. So that would be the way some of these institutions came. So anyway, you picked up on the thread that I was trying to leave with everyone, which is that there's a bunch of banks who start sort of 1800s, early 1900s, even in emerging market. I'll give you another example in the emerging market / BRICS countries, the Bank of Russia. So the Bank of Russia has a sort of three unique periods in it. One was the period under Tsarist Russia, which obviously had a very imperial tone to it. And the treasury and the central bank reported directly, of course, to the Tsar. Then it went into the central bank of the Soviet Union, which is in some bizarre sense almost the opposite, which is a central bank of a collectivized country that was actually run by a Politburo. And then starting roughly after Gorbachev, but certainly during the time of Yeltsin, it effectively became the Bank of Russia as we know it today, which is a central bank of the classic emerging market type. By the way, the only central bank today among emerging markets that's actually led by a woman, at least major central bank led by a woman in emerging markets. So that's the Bank of Russia. But other countries, People's Republic China has something we all affectionately in the markets call PBOC. The PBOC is born in 1948, right at the time of the revolution in China. And the previous incarnation, to use a very Asian emerging market word, actually went across the straits to Taiwan.
So that moved with the Republicans, yes.
Yeah, so the Kuomintang essentially took the PBOC with them to Taiwan, and so that was born from scratch. So was the Bank of Korea, and so on. So different banks were born in different eras. Of course, they have been able to grow into their newer eras by and large. But the reason I mentioned this long history is sometimes the history does play a role. So for instance, the Bank of Turkey has remnants of the Ottoman Empire, significant sort of DNA of what I would call Republican Turkey, and then a slight change in DNA from after 2002, 2003, when the AK Party came into power in Turkey, where it changed character to what I would call a highly inclusive and democratic institution, but one that is a little bit less, in Turkey's context, less Republican in character and so on. So each of these has a unique history, and the history is relevant a little bit in how they are considered accountable to their respective governments and populations, is sometimes important for the language and semantics that they use, and is oftentimes responsible for how within the political economy of that country their mandates are organized.
So given how in the last episode we discussed the US Fed having an initial mandate of just banking sector stability with a capital S, then shifting to post-World War II employment focus, and I guess post-70s inflation focus, and now the thing is turned around back to employment in 2020. What has been the central mandate of these various other central banks in emerging markets? Maybe we can start with India.
Before I go country by country, very quickly, let me just say that just a quick clarification on the Fed. The Fed still has what we call a dual mandate. The dual mandate is one, maximum employment, two, price stability, which is defined as an inflation target of 2% now. And that started in 1975, as we discussed at length in the last episode. What the Fed has done is, both through technical means and otherwise, change the emphasis back from price stability back to employment. Both mandates are still valid, and the Fed is widely described to continue to have a dual mandate, just for clarity. Now, generalizing the objectives of central banks, let me just say that there are usually 5 objectives, and in either a specific one of them or combinations of them. So they are price stability, which we talked about in the context of the Fed, employment, economic growth, which is sometimes much more of an emerging market phenomenon. It's a bit of a catch-all, as opposed to something specific like employment. It could be economic growth. It could be financial sector stability, right? And this could be institutional development, it could be other things. And in fact, the RBI's mandate for much after the independence, and certainly the PBOC's mandate for a long time after 1948, really focused on this word financial stability, which basically meant we can do whatever we like so long as we can broadly defend to you that we are improving financial stability. So that allowed them to do growth sometimes, currency sometimes, and so on. And then the last one is currency, both stability and value. Some people think of that as really an inflation mandate, particularly for those economies that might have reasonable exposure to the external environment. So a smaller country like Singapore at different points in its history has had currency stability as an important objective of the central bank, because in terms of gross exports, at least 120% of the GDP is gross exports in Singapore. So these are usually the 5 objectives that central banks go after. Historically, and this is well before the 70s and 80s, objectives were less clear and specific, but were often described by functions. So in some older texts of economics, you would actually say the central bank has the following 6 functions. Whereas nowadays, the received wisdom is that at least in democracies, the best way for a central bank to have civilian accountability is through a mechanism of purpose and mandate, but for the functioning of that mandate to be relatively independent and left to the technocrats within a function of the central bank, if you see what I mean. So just as a mild detour, if I were to speak about the Monetary Policy Committee of India, which was established in 2016, and by the way, it just finished its first 4-year term, so it's actually a good case study and analysis of the last 4 years and how did it accomplish what it was supposed to accomplish and all of that. And it was also an interesting sort of factoid, if you will, is that as far as I know, India is sort of the last country to jump on the Monetary Policy Committee bandwagon. The first one was New Zealand in the 80s and or early 90s. And then since then, we've had sort of 30 years of Monetary Policy Committee and a very specific focus on inflation. And India was the last country to officially create a Monetary Policy Committee. The UK famously has a Monetary Policy Committee that works with an inflation target. And now India does as well. As people know on the call, India's goal is a range from 2 to 6 with a central tendency of 4.
So in that sense, are we a little too late on this, or was this correct and proper for India and where it was? I mean, we saw crazy amounts of inflation in India and stagflation about perhaps a decade ago. So are we late to this, especially with the Fed moving back to employment as number 1, inflation as number 2 now in 2020?
Yeah, I guess better late than never, to use another Indian slogan. But yes, I think we have been late to the inflation party, so to speak, right? I mean, the discussion about inflation and targeting inflation has been with us for easily 20, 25 years. The reminder of it came in so many different ways. Everything from before actually 2008, if you recall, even Ben Bernanke at the Fed was talking about what in technical terms is a nominal anchor for interest rates, which simply means there's a target for inflation in a nominal sense. And before that, the Washington Consensus had very explicit sort of guidelines oriented towards inflation and so on. Without getting too rigid about which ism to follow, I think the credibility of a central bank is related to how they can, in the pursuit of their goals, maintain price stability. As time has evolved, that price stability in most developed markets is understood to be about 2%. So it may sound strange to the non-economists on the call that the goal of price stability in the Fed and the Bundesbank and the ECB now, virtually any large developed country, is actually not 0 but 2% inflation. That's a very technical explanation why. The reason for that, and we touched on it last time, is that if the number stops dropping below 2, then you change inflation expectations. And inflation expectations turn out to be as important, if not more important than actual inflation in the setting of both interest rates and forward-looking inflation, and sort of in a circle between the two, right? If you understand what I'm trying to say. So in effect, when inflation, let's say, gets to 1%, you expect inflation to go below 0, and therefore you are actually in a disinflationary state. The empirical answer that most central banks have found is that, at least in developed markets, that number is 2. The postulate is that in emerging markets in its stage of development, like India today, is that number is probably closer to 4. And in a country like China, you have been heading from 4 towards 2, and you're probably at something like 2.5 at this moment in speak, where the so-called goal of price stability is met at that anchor of 2%.
So does this also mean that if, say, inflation drops significantly below that number, it has implications for growth, employment, and other things? Like if India suddenly gets to 0% inflation, or less than 1% inflation, is that actually an indicator that our economy is in deep trouble?
Yes.
In what way? Because when we think of inflation, again, from a very individual point of view, it's like prices are rising faster, and prices have stabilized. But does at least having that little bit of inflation do something with each of us, with firms and so on, that sort of keeps us going?
Yes. So basically what it does is that little bit of inflation, and the optimal amount of that little bit of inflation is what all the central banks are obsessed about. But that little bit of inflation protects you from thoughts of deflation. And the real scourge on an economy is deflation.
Because if things are deflating, I don't want to spend now, right? Because my money will be worth more later. Is that the idea?
In simple terms, that's the idea, but it has multiple effects, which is you can't grow, then debt becomes a bigger problem in a deflation. So from the point of view of a central bank and an economy, and this is the lesson learned from the Depression in the 30s, is that of all the states between debt and deflation and inflation, the worst state for an economy to find itself is debt deflation. And therefore, you need to act in order to, one, reduce the cost of that state, and two, to get yourself out of that state. So in effect, actually, even last week's announcement by the Fed is to reduce the probability that you will actually remain in debt deflation or debt disinflation in the US. So that is sort of the if you have to think of all the diseases that might scare an economy, the worst disease, so to speak, is debt deflation. Not that other diseases are not diseases, but it's just that they are less scary than the debt deflation.
On that note, can we go back to the US Fed, because we talked about its implications for the US economy, but the dollar and the Fed, their implications have always been global. And in India, I guess we've felt this most acutely, about 7 odd years ago, when the taper tantrum happened. So could you maybe give us a bit of a refresher on that, and then let's talk about what the latest announcements mean in the short term and the medium term for India and others?
So let me start with the taper tantrum, and we'll talk about the short-term implication of the Fed's move. So the taper tantrum, for those of you who need a little aid memoir, happened in 2013. And this was the instance where the Fed said, after the 2009 crisis, we have kept rates low enough for long enough, and it seems probable that inflation will start inching up towards our 2% goal. And therefore, you may expect from us a normalization of interest rates to higher points than we have currently. So that's sort of the communication that that they had throughout 2013. And what that then implies to markets is that the substantially global capital, the dollar capital that had flooded the market, particularly after the liquidity easings of 2008-9, essentially, at least on the margin, would be withdrawn from the world. And the tantrum comes from emerging markets essentially reacting very badly to that philosophy of tapering low interest rates. I mean, it's a bit of a non-descriptive word because it's actually not tapering, it's actually increasing interest rates, but they mean it in the sense of tapering the gap in interest rates from some sort of normal rates or whatever they had in their head, if you see what I'm saying. So it's a little bit misused, the word taper, but it means reduction of the gap or an increase in dollar interest rates. And that scared emerging markets. So unfortunately, what happens when you have that kind of taper tantrum is one, money actually starts moving. And when it starts moving, it withdraws, both FDI and FII withdraws from emerging markets. That puts pressure on the balance of payments, I guess is the better way to say it, in terms of capital flow, which in turn puts pressure on the balance of the current account, which then in turn puts pressure on the currency, which in order to create an equilibrium actually loses value, as famously the rupee did in 2013. And then that becomes, unfortunately, a vicious cycle where the currency is adjusting downward in order to adjust for lower capital flows, and the lower capital flows are adjusting downwards in order to adjust for lower currencies. So it becomes a sort of a self-feeding prophecy as that taper tantrum triggers a vicious cycle in terms of emerging markets. So the simple rule is, particularly the Fed, but certainly also works with the ECB and the Bank of England, as hard currency central banks tighten, global liquidity flow decreases. If both the anticipation and the actuality of global liquidity flow is downward, then emerging market currencies tend to drift downward. And with that comes pressure on the current account, and with that comes further decline in liquidity, and it's negative.
And all this is because people are borrowing in dollars, pounds, or euros in order to invest in emerging markets, right? And this can be in the form of FDI, hard long-term investment, or FIIs, which are sort of investment in equity and so on.
Right. You could either be borrowing in the context of a hedge fund, for instance. So you have an equity of $10 and you borrow $60 against it, and then you put $70 in the emerging markets. So you could be borrowing in exactly the way you're saying it. Or you could be owning that capital, right? You could be a large Canadian pension plan. Every month, the Canadian Fire or Canadian teachers are contributing defined contribution money into a plan. They have trillions of dollars of it. That trillions of dollars essentially gets allocated to emerging markets. On margin, if I'm a little less attracted to India, I would take out 20, 50, $75 billion and say buy US treasuries or Canadian treasuries instead of buying Indian either debt or equity directly. Or a strategic could be doing the same thing, which is that Facebook could be saying, hey, listen, I'm uncertain about the prospects in India. Let me now make sure that my mergers and acquisitions activity is focused in the US. In both terms, it could be either borrowing money or actually just your own money, you're putting it out into the world.
Okay. So in that context, then, if the announcements from last week had not taken place, was there always a risk of another taper coming our way, interest rates in the US going up, and therefore would that be a cause of uncertainty in emerging markets?
Absolutely. Yeah. So the biggest contribution of modern economics, if you will, is that economics works on the margin. And on the margin, what happened last week was the Fed said that the probability of another taper tantrum went down significantly. It didn't go to zero, but it went down significantly.
And definitely even more significantly in the immediate term, right? Next 3-4 months.
Exactly. So let's just, to do a little Hindi film thing, do a flashback to 2010, right? And suppose the Fed, instead of 2020, had said the same thing in 2010. Then the probability of what was threatened in 2013, but never actually really happened in 2013. So the Fed actually didn't taper much at all in 2013. Only the markets tapered in anticipation of the Fed. The Fed didn't do much. If you actually read the Fed minutes from each of those months, they will say unanimous decision not to act, one dissenter. Right? So it's very common of the Fed minutes of 2013 that nothing really actually happened. But just their speaking made market interest rates move, which then caused all the flutter that we had in 2013. So if in 2010 the Fed had said had put in place the policy that we got last week in 2020, then the probability of what happened in 2013 would have gone down. And as I said, it wouldn't have gone to zero, but on margin, it would have declined substantially enough that the rate at which market instruments reacted to it would have been much, much lower. And what we all said eventually, which is that the taper tantrum turned out into a taper whimper, may have started as a taper whimper, because the probability of actual tapering would have been even lower than it was in 2013. So that's really the implication, both for emerging markets and India in particular, of the Fed policy doctrine, if you will, from last week. And that is that the probability of tapering has reduced. The emphasis on inflation showing through has reduced. Therefore, the tolerance of inflation is likely to be greater at the Fed. All of which implies that for a bank like the Reserve Bank or for market participants in India, that the probability of the dollar liquidity being withdrawn is lower now than it was a week ago.
So Narayan, here I completely understand that we need capital for India to be able to grow, right? And there are domestic constraints, and thanks with things like the US Fed and their interest rates, there are international constraints. So that's one constraint that's removed. So, or at least the probability of that constraint becoming a constraint has become lesser. I understand and fully get what this might mean in the next 2-3 years, right? That we have a bit of a window, more leg room for our economy to grow and for this particular thing not to be a constraint. But in the immediate, do we care as much about FDIs and FIIs, given that we know that our economy is crashing, economic activity has collapsed in the light of COVID. We even saw that the GDP decline might have begun before the pandemic struck us. So what does this mean right now, be it for the RBI, for the economy, or for anyone else?
So if I were to say the immediate term, the short term, and the long term, and just break it up for ease of use as 3 months, 3 years, and beyond, right? The immediate focus has to be on restoring economic activity. Because bizarrely, we have a very non-emerging market problem happening in front of our eyes, which is that India is accumulating dollars at a furious rate of $3 billion a week on the RBI balance sheet. And this is a bit like a thin person gaining mass, but in a very inappropriate way, essentially gaining it out of eating protein shakes or whatever, as opposed to sustainably so. And the reason is very simple. Basically what is happening is that the economic activity in India has collapsed, particularly related to the external sector. Imports have collapsed, particularly relative to exports. So there is no Indian demand for dollars in the manufacturing sector in particular and the economy broadly, right? So the Reserve Bank of India is actually helping that situation by selling the rupee and buying dollar, which is not something the RBI does often, right? Usually the RBI is doing its level best to defend the rupee. But because imports have collapsed, the pressure is on the rupee to go towards 70. in the 3-month time frame. Of course, this is only temporary, and of course, this is not likely to last, but it has real consequences. The real consequence right now, for instance, is that the reserves on the book of the RBI at that rate have now increased to $540 billion. Most people will sort of remember, I mean, they batted their eyes 3 months ago and it was 440 or whatever it was. In fact, in an early podcast in BIC, I remember using that term, number, Pavan. And if you recall, we were worried about the rupee declining. That is still the medium-term scenario, but in the very short term, we've had the exact opposite effect for the reason that the extraordinary fiscal stimulus in the US is one, extraordinary, and two, very, very large. Two, it happened very quickly. Three, the Indian action has been very modest on fiscal. So the relative fiscal profligacy, if you will, has been way in the camp of the US. And two, on the import side, we've had a collapse in imports and therefore no demand for dollars in India, and that has created a pressure. We've also had sort of ad hoc events like the Reliance Geo funding all in dollars of a reasonably significant sum, 10, 15, $20 billion of cash coming into those kind of FDI and investments, all of which has led to a glut of dollars that have then been bought back by the RBI and on its balance sheet. So this is and then in that sense, the dollar has been exported out of the country, so to speak, through that mechanism. So this is quite bizarre and very likely to be very short term. So that's the 3-month phenomenon. By the way, FDI, FII, and in the context of India, diaspora flow are always important in this, broadly speaking, growth phase of our economy. Okay? So we can't take the eye off it. We can't take our focus off it. We need to keep FDI, regulations related to FII, and the interest of the Indian diaspora engaged with India at all times, because the three together essentially lend great stability to India's balance of payments. So for instance, it's not widely spoken about, but the Indian diaspora remittances are order of magnitude $80 billion a year. And except for what happens after the pandemic, which we are not yet entirely sure about, that has been rock solid for a long time. So we need much more scholarship. We need much more political involvement. We need much more engagement. We need much more to ensure that key economic pillar of our balance of payments can continue to perform that function by the remittances that come from the Indian diaspora abroad. Yeah. So these FII, FDI, and diaspora remittances should be continually in focus. But it is possible that in the 3-year period, they will take a larger than expected role, because if there is indeed a cyclical recovery in the West, then that cyclical recovery in the West will search for yield in many locations, of which India is an attractive destination, and therefore could likely be one destination for that FDI, one major destination for that FDI and FII. So we could actually have the rupee reasonably supported and FDI and FII in a very positive scenario. May or may not happen, but that's a possibility or a probability.
And the US Fed's actions are only helping that, right? Or at least their announcements.
The US Fed's actions are helping that and assuring a stronger cyclical recovery than it otherwise might have been, is sort of what I'm saying. Yeah. So that's on the 3-year. On the longer term, all of India's real ailments need to be addressed. And you can win the cyclical beauty parade relatively easily simply by presenting the yield or the return. But for winning the 5-year, 6-year, 7-year game, you need to actually do what I call Reform 3.0 in India. And that is very, very difficult, but necessary. So the question is, will we do it? So if I can postulate a very positive scenario for 7 or 8 years, it would be that India undertakes several reforms, given the difficulty we are in, and in some senses camouflaging the reform process with the difficulties we are in, as we did in 91, 92. And as we did a little bit in 2001, 2002 under Vajpayee, which are in my view Reform 1.0 and Reform 2.0, and now use this challenging economic time to do Reforms 3.0. If we did that, we could actually see forward 7 years where we are actually revenue deficit neutral, with a productivity increase between now and then, and may not be to the fullest extent of what happened, but a little sort of back to the future of what happened between 2003 and 2007. But that is a scenario. I'm not expecting that. In order to expect that, we will actually need to take reform action. And that reform action needs to be imaginative, it needs to be bold, and it needs to have the political capability to sell it to the legislature and the people between now and the implementation. And all of those at the moment, the willingness is at least appears to be missing. But there is that possibility that we can recover that ground if we do that. But the Fed's action, and I'll stop with this, I've spoken for a bit, but is that it allows us a little longer of a time in which to accomplish this reform step. So we have a little bit more cushion thanks to what the Fed did last week than we did before then.
Then the other extreme of what might happen in India would be that we will see some cyclical recovery next year, but we might rest on those laurels, so we might see happy growth numbers for a year or maybe even 2 years. But since we've not taken any structural reform steps, that peters off again very, very quickly, right? So that's the other end of the spectrum.
Exactly. So if you think about what happened in the decade of the 2010s, we had some version of this. We were just beginning to pick up cyclically in 2012, for instance, right? And then in 2013, we had the taper tantrum. So that took us all back down again with a currency shock as well, right? Then with the new government in 2014, we had great hopes, but we shot ourselves in the foot with demonetization. Again, we were just beginning to recover in a global synchronous recovery in 2017, when with shoddy implementation on the GST, we actually interrupted growth again, right? And throughout it all, we never had sustained cyclical recovery, except for the brief bit till 2012-13. And we didn't have reform-based sustainable recovery at all, because reform, except for the GST step, was not consistent and widespread enough, right? But we'll need to reverse that or revise that history for the decade of the 2020s by saying we will absolutely need reform in order to sustain longer term growth prospects and longer term FDI, longer term FII, and the interest of the diaspora. And if we can do the reform, then this can be a continuing expansion rather than just a cyclical recovery.
Thanks, Narayan. And so one final broad question to you is that in this coming decade, some of the things that were there in the last decade or the decade before can no longer be taken for granted, right? I mean, we were perhaps moving towards a world with more and freer trade, but now we are seeing more economic nationalism on the rise. We are seeing borders that are closing, not just because of the pandemic, but also because of other reasons. So with sort of trade, movement of people, and also access to technology changing and getting a more national character now, what do you think will be added constraints or challenges for India and for others?
Yeah, so maybe I'll leave you, Pavan, perhaps for a conversation some other time with a teaser. And that is that the three elements of progress, which have been trade, technology, and talent, are all under friction, if you will. Trade has gone, if not to deglobalization, to what is now widely referred to as globalization. Technology, which was sort of without moats, except for China, has now begun to be with moats almost everywhere, and therefore the cost and ubiquity of technology will be more in question. Of course, from the other side, it could be a positive in that market monopolies or market oligopolies may actually be deconstructed in this time, right? That then allows a very positive occurrence of competitive, young, innovative firms. So somewhat of what happened in the breakup of the old Microsoft and way before in what happened with Bell Labs and so on. Will something like that happen with the big tech companies in this decade? We don't know. But there could be some positive implications of a change in technology paradigms. And then last but not least, there is already an evolving change in the talent paradigm. A lot of that depends on what the United States ends up doing with its higher education system. But if the interference with the higher education system through the visa system is great, then the automatic destination for the world's best to at least tour through the United States will change. That will have then consequences worldwide in technology and innovation and development and so on. It may have some positive nationalistic consequences for some countries, but it could have a negative international and technology and innovation consequences for the world. So I'd say watch the space. Technology and talent is changing in the decade of the 20s very differently from the decade of the 10s and the period before that. And it seems rather likely that these forces will be mega trends that will have a lot of implication for how economies evolve and how sort of natural growth rates of economies can be supported by tailwinds from outside or not supported, as the case may be, from tailwinds from outside.
Narayan, thank you so much. As always, it's an absolute pleasure and it's a mind-expanding experience to talk to you about these topics. Thank you so much for coming again on BIC Talks.
Thank you, Pavan.
Thank you for listening in till the end. Please share this episode with a friend on social media, WhatsApp, or anywhere else. It would mean the world to us. And in case you're listening via iTunes or Apple Podcasts, please leave us a rating and a review. Subscribe to BIC Talks on email or your favorite podcast app and don't miss out on future episodes. This episode of BIC Talks has Gaurav Krishna as our sound engineer with support from S. Sarvanaraj and Lekha Naidu. And the accompanying episode artwork was made by Chandni Venkataraman.
Thank you for listening to this episode of BIC Talks. This podcast can be accessed on our website, bangaloreinternationalcentre.org, as well as on any of your favorite podcast platforms. Tune in for new episodes every week, and do subscribe to our YouTube channel and follow our Facebook, Twitter, and Instagram pages to stay informed on our latest updates.